Welcome to the presentation on long-lived assets. Long-lived assets, just so you know, the other terms used to describe long-lived assets are also referred to as fixed assets or non-current assets. So typically property, plant and equipment and so on fall within the category of long-lived assets. In this presentation, we will first talk about how we recognize the cost of long-lived assets, and essentially what we do is capitalize the money spent on assets. We are going to then cover the concept of what costs get capitalized versus what costs get expensed. We will take the special case of interest expense, where we borrow money to construct an asset. What do we do with the interest expense? Then we'll talk about intangible assets, both identifiable and non-identifiable intangible assets. Then depreciation methods like straight line, accelerated, etc. Amortization of intangible assets. The revaluation model, which is an alternative to the cost model. So most of this discussion will be based on what's called the cost model, which is what is traditionally used. IFRS also allows a revaluation model under certain circumstances, so we'll talk about that. We'll talk about the impairment of assets under both IFRS and US GAAP, derecognition of asset, so this is where we either sell or abandon or exchange an asset, and finally presentation and disclosure of information related to long-lived assets. Let's start by talking about capitalization. If an asset contributes to generating revenue over multiple periods, the matching principle suggests that you should spread the asset cost over multiple periods. So the logic is straightforward. Let's say that in December 2010, you buy an asset for $12,000, and this asset is really going to give you value over the next 5 years. So from 2011 to 2015 is when you will use this asset. Let's say it's a piece of equipment which will generate widgets. So you really want to expense this item over this useful period of the asset. So what we do in December 2010 is capitalize the asset, which means we create a asset called equipment, and then we expense it out through a process called depreciation over the years where it is used. So in essence, depreciation or amortization is the spreading method. So that's how we spread that $12,000 over the years where the asset is being used. The term depreciation is typically used for tangible assets, and amortization is used for intangible assets such as a copyright or a patent, as long as the intangible asset has a finite life. More on this later. If cost will result in higher future earnings, we capitalize. So the question here is, if there is any doubt as to whether the asset will result in future higher earnings, so if we are sure that it will result, or reasonably sure that it will result in future higher earnings, such as the example I gave here, then we capitalize. So we create a fixed asset of sorts. But if we are not sure, so if we have if we've spent money on some equipment where it is very uncertain as to whether it will have an impact on future earnings, then the principle of conservatism dictates that we simply expense. So in that case, whenever say you spend $2,000, you just show that as an expense in the year or the period where that expenditure is made. Now, what costs do we capitalize when we buy a piece of equipment or when we buy any fixed asset? Take a simple example. Say you buy equipment for $550,000. And say this includes 5,000 freight, which is the inbound freight. This is the freight cost that you pay to get the equipment to the plant where you are using it. and you also pay 12,000 as taxes. Then you spend 20,000 to install the equipment. The people who will be operating this machine need to be trained, and let's say that training cost is 17,500. During the first year, let's say that during year 1 the routine repair and maintenance is 5,000, and then at the end of the year there is a fire because of which the engine was destroyed, and the cost to rebuild the engine is 85,000. Now what do you capitalize and what do you expense? What we have to do is the initial money spent on the equipment, including freight and taxes, this is capitalized. Any installation cost, so the cost it takes you to make the machine usable, is also capitalized. Training cost is typically expensed. Routine repair and maintenance is expensed. And this is somewhat subjective, but if you rebuild the engine and this money, this expenditure is obviously going to have a future benefit, you capitalize this amount. So there is obviously more detail here in accounting manuals, but for the purposes of the CFA exam, as long as you can understand this basic structure, that any money spent on the equipment and setting it up, the taxes, the freight to bring it in, all capitalized. If you rebuild or enhance the machine, that's capitalized, but training costs, routine repair and maintenance, these are expensed. Effects of capitalizing versus expensing. The CFA Institute loves to ask questions where you are given two companies, one capitalizes, one expenses. So since there is some subjectivity involved in terms of whether to capitalize or not, different companies might make different accounting choices, and if the two companies are similar in all respects and they've just made a different accounting choice, fundamentally then there should be no difference in the two companies. However, these accounting choices, the accounting choice of whether to capitalize or expense, will have an impact on assets, liabilities, ratios, profitability, etc. So you need to understand the impact. Now this table that you see here is from the context of two companies. One capitalizes, one expenses, and they are similar in all other respects. So let's look at what happens to total assets. Since capitalizing creates an asset, the total asset, so this creates an asset, extra assets. The expense company, let's say that you spend $2,000 on a new asset. The capitalizing company initially will increase their value of assets by 2,000, whereas the expensing company will simply show that entire 2,000 as a expense in the income statement. So as you would expect, the total assets for the capitalizing company are higher relative to the expensing company. Equity will also be higher since assets is equal to liabilities plus equity. The liability is the same for both the capitalizing and expensing firm. Since asset is higher, then equity will be higher for the capitalizing firm. Income variability will be lower for the capitalizing firm. This is because a firm that capitalizes spreads the expense somewhat evenly over years. So that expense is spread out through a process called depreciation, which we will see in detail later. So because the expense of buying the machine is spread out over years through depreciation, the income variability is relatively low compared to the expensing firm. For the expensing firm, every year that it spends money on equipment, the expense will go up, and so the net income will go down. And then in years where the company is not buying any equipment, the net income will be higher. So lot more variability depending on when the company buys its equipment. Net income in the first year will be higher for the capitalizing firm because it's not recognizing the entire cost of the equipment as expense. So initially the net income will be higher, but in subsequent years net income will be lower because of the depreciation expense. We are spreading the expense out, so in years 2, 3, 4, etc., we will be showing a depreciation expense for the capitalizing firm, but the expensing firm will not have any depreciation expense in subsequent years. The cash flow from operations is higher for the capitalizing firm, and this is a common question. Why is it higher? When for the capitalizing firm, let's say that it bought this asset for $2,000, so that $2,000 is shown as a cash outflow in the investing section of the cash flow statement. So this 2000 is reducing CFI, it's not impacting CFO, and that's why for the capitalizing firm the cash flow from operations will be higher, because this 2000 expense is the 2000 cash outflow is shown in CFI, so it's shown under the investing section. Hence for the capitalizing firm the cash flow from investment will be lower relative to the expensing firm. The debt to equity ratio will be lower, and a low debt to equity ratio is a good thing. This is because, as you saw earlier, the equity for the capitalizing firm will be higher, and since equity is higher, debt is the same for both capitalizing and expensing firm. The denominator is higher, so the overall fraction is lower. The interest coverage in the first year will be higher. Remember, interest coverage refers to our operating income or EBIT divided by the amount of interest that needs to be paid. Now, in the first year, the capitalizing firm will have a higher operating income, because the entire cost that you spent, or the money that you spent on the equipment is being spread out. So your operating income is higher in the first year. Since this is higher, the interest payment is the same for both capitalizing and expensing. So your overall interest coverage ratio is higher in the initial year, in the first year, the year where you spend money on the equipment. In subsequent years, because of the depreciation expense, remember depreciation expense reduces operating income, so subsequent years operating income goes down, and hence the interest coverage ratio in subsequent years is lower for the capitalizing firm. Make sure you spend a few minutes on this slide and understand this well, because this is a high probability question. Capitalizing versus expensing, some more financial statement effects. This is building on what you just saw. So as a recap, for firms capitalizing costs, they have higher assets and higher equity. The return on assets and return on equity in the first year. So capitalizing firms will have higher ratios because income is higher. So remember, return on assets, so ROA is equal to net income divided by the total assets, and ROE is net income divided by equity. So in the first year, for both for the capitalizing firm, the net income will obviously be much higher than an expensing firm, because we are spreading the expense out over multiple years. So in year one, the net income will be much higher for capitalizing firms. The assets and hence equity will actually also be higher for the capitalizing firm for reasons that we just talked about. But in the first year, the net income is so much higher, relatively speaking, that the overall profitability ratios will be higher for the capitalizing firm. We can do this with an example later, but at this stage, let's just understand this core concept. In later years, the capitalizing firm will have lower return on asset and ROE ratios, because the income is lower and asset equity asset slash equity is higher. So this is easy to understand. So if you just take net income over total assets, in subsequent years the net income is lower because we also have the depreciation expense. For capitalizing firm, the total assets are higher because the assets are being capitalized, and hence, as you would expect, in subsequent years we have lower profitability ratios. Capitalization of borrowing slash interest costs. Now this applies where you borrow money to construct an asset, and let's say you are paying interest on that borrowed money. What do you do with that interest? And the answer is that the interest that is paid during construction of the asset is capitalized as part of the asset cost, and use the rate. So the question is what interest rate to use, and the answer is that you should use the rate on borrowing related to construction. So if you borrow 10 million to construct and you are paying 12% on that borrowed money, then you use 12%. If no construction debt is outstanding, so you don't have any debt specific to that construction, then you can use an interest rate based on existing unrelated debt. In general, IFRS and US GAAP are similar with regards to capitalization of borrowing and interest costs. The only slight difference is that with IFRS, if you invest your borrowed money, so you borrow 10 million and invest it, let's say that it's sitting in a bank, the interest that you collect on those funds offset the capitalized cost. This offsetting is not allowed under US GAAP. Let's do a very simple example. Say you borrow 10 million rupees at 10%, and your construction will last 2 years for an asset that will be used for 10 years after that. And let's say that you earn 10,000 rupees by investing. So over the 2-year period, you earn 10,000 rupees by investing this money, or the money is sitting in a bank, and the profit or the interest that you get is 10,000. So what is capitalized? The amount of money or the capitalized interest over the 2 years, which will be added to the value or the capitalized value of the asset, is going to be 10% of 10 million multiplied by 2, because this is 2 years. So 10% of 10 million is 1 million multiplied by 2 is equal to 2 million. So 2 million rupees will be capitalized. But since if we are using IFRS, which is what we would be doing in almost every country other than the US, we subtract the 100,000. So subtract the 0.1 million, so minus 0.1 million. So our total capitalized interest is going to be 1.9 million rupees. This should give you a good idea. If you want to be extra diligent about this subtopic, then you can look at example 2 in the curriculum, and practice problem 2 at the end of this chapter also gives you a good sense on how to deal with capitalized interest. Some analytical considerations when dealing with capitalized interest. Notice that the interest that you pay, even though you are actually paying that interest on money that you have borrowed to construct an asset, but it is not reported as an interest expense on the income statement, and hence companies that use capitalized interest will have higher net income during capitalized period. So lower interest expense, hence higher reported net income, and also higher interest coverage ratio during capitalization period, because our income is even for companies. So let's just do this very quickly. Operating income over interest. So let's say that interest is not treated as an operating expense, so the operating income is not impacted. But if we are using a lower interest expense in the denominator, then the overall ratio seems better. Capitalized interest is categorized as an investment outflow on the cash flow statement. Since capitalized interest is categorized as an investment, therefore the cash flow from operations will be overstated. So if typically interest is shown as a operating expense, which it is under US GAAP and could be shown as an operating expense under IFRS, but capitalized interest is then shown as a investment outflow and it's not shown under operating outflows. Hence CFO or cash flow from operations will be overstated. When we have capitalized interest, that increases the value of our assets. Hence we will have higher asset values on the balance sheet, and when asset values are higher, then equity values will also be higher. Now, how do we recognize this expense? We recognize it through depreciation. So if you have an asset which has a capitalized interest component of 2000, then when the asset is depreciated, it's the total value of the asset which includes the capitalized interest component. So the total value of the asset is depreciated. So during depreciation, we are essentially then recognizing the interest expense also. Higher asset values and depreciation lead to lower net income, lower operating profit or EBIT, and lower interest coverage over subsequent periods. So what this is saying is that in subsequent periods, since we have higher asset values, we will therefore have higher depreciation, which is an expense. Higher depreciation will mean lower income. Now, how should an analyst, so what we've described here is basically under IFRS and US GAAP, capitalized interest we need to have capitalized interest. So that's what accountants must do. But as an analyst, it is advisable that you adjust financial statements and ratios, assuming that all the capitalized interest is indeed expensed. The logic here is that even though we are capitalizing the interest, but that money is being paid, so it is actually an expense. So you should adjust your assets, your equity, your income to assuming that the capitalized interest is actually expensed. So that will give you a more realistic picture of what is going on. So essentially what is being advised here is that you undo the impact of capitalized interest and then see what happens to assets, equity, and profit numbers, as well as various relevant ratios. Now let's talk about intangible assets. There are two categories of intangible assets, identifiable and unidentifiable. As a general point, as the name implies, intangible assets are assets that you cannot physically touch and feel. So obviously the opposite to this would be tangible assets. So your tangible fixed assets would typically be property, plant, and equipment. So with intangible assets, the identifiable category are assets which can be separated from the firm. So the criteria for identifiable means they can be separated from the firm, controlled by the firm, and there is some future benefit, economic benefit from these assets. Classic examples are patents, copyrights, trademarks. Now these identifiable assets can have a finite life. So for example, you might have a 5-year copyright or a 6-year patent and so on, or it might be infinite. So for example, your trademark might have a infinite life and so on. When you have a finite life, then the value of that intangible asset is amortized over its useful life, and this amortization is almost exactly like depreciation. Unidentifiable intangible assets cannot be purchased separately. The classic example of unidentifiable intangible asset is goodwill. So goodwill is the excess of purchase price over the fair value of identifiable asset slash liabilities. So the point is this: let's say that you buy a business. So you buy 100% of a business where the net asset value, the fair value of the net assets. So let's say that the fair value of the assets is 100 minus the fair value of this is 60 is the fair value of the liabilities. So the net assets are worth 40. And this, we are not talking here about book values. We are saying that we look at all the assets, we look at the fair market value of the assets, that's 100. We look at all the liabilities and their fair market value, let's say that's 60. Then we can say that the fair market value of the net assets is 40. And for this business, let's say you pay 50. So you pay 10 million above the 40 million fair value. That 10 million is the goodwill. Now you could not have bought that 10 million separately. You can't just identify that 10 million as as something that you buy separately. So this is unidentifiable. You only get the 10 million when you buy the business. So that is goodwill. Since it is not identifiable and it cannot be separated from the business, there is no concept of amortization. However, we must periodically test for impairment. So this periodically means that at least once a year you need to check whether this 10 million goodwill still holds. And the relatively simple way of doing this is that at least once a year you value the business and see whether the total value of the business still exceeds the value of the fair value of the assets by 10 million or more. If not, then you need to impair goodwill, and we'll talk about impairment later. Now, how do we account for intangible assets? This depends on how you got the assets. So there are three ways in which you can get intangible assets. One is purchased in situation other than business combinations. So business combination means where you merge with another business or buy another business. So since we are talking about purchased in situations other than a business combination, this is just a slightly complicated way of saying that you bought an intangible asset. So if you buy a copyright or buy a patent, then you simply record the value of that copyright or patent at the value that you paid. So assuming you paid fair value, so say you paid 5 million for a copyright, and you then simply record this as a intangible asset worth 5 million. So you create an asset worth 5 million on your balance sheet. So this is one way. It is also possible that you develop a patent internally. So the second way of getting an intangible asset is that you develop it internally. Under IFRS, the research costs need to be expensed. So if you are developing a patent and you are not sure yet whether there will be some commercial value out of what you are doing, that is the research phase. So any research costs are expensed. Once you are confident that the patent that you are developing is, so let's say you are past the research phase and now you are developing the patent, and typically this would be a stage where you are now going to expect future economic benefits, then the development costs can be capitalized. So here you can now create a asset. Under US GAAP, there is less flexibility and you need to expense research and development costs. The third category is where you acquire a business. So we will study this in a lot more detail in level 2 of the CFA, but all you need to know at this stage is that let's say that company A acquires company B. So when you acquire company B, there will be potentially some goodwill, then there will also be some identifiable assets such as copyrights, patents, etc. that you have acquired. So In the acquisition method, any price paid over, so you show these at fair value, and any price that you pay above the fair value of the identifiable assets, be they tangible or intangible, is shown as goodwill. A special case for software. Now, companies can either develop software for internal use or they can develop software for sale to others. Cost incurred to develop software for sale to others is expensed as incurred until the product's technological feasibility has been established. Once the technological feasibility has been established, then the firm can capitalize if it wants. However, this is fairly subjective. Microsoft, for example, just expenses all its costs, software development costs. So subsequent costs are capitalized, but as I just said, establishing feasibility is subjective. Hence, capitalization practices can differ from firm to firm. The cost incurred to develop software for internal use is expensed in the initial discovery definition phase. So while you are still uncertain as to whether this software will be of use to you, so which might be the case in the very early phases, then you expense. But once you are sure that the software will be of use to your company, then you can capitalize the costs.